Steve Schwartzman and Blackstone Group just recently acquired Jersey Mike's for over $8 billion. That's about 40x multiple. We'll look at the numbers here real quick, but it's about 40 times the earnings of Jersey Mike's. That's a lot of money for a sandwich franchise, you may be thinking. But we'll see how it could still mean over 10x returns for Blackstone Group. Let's analyze the numbers just high level. Jersey Mike's is a franchise that has about 3,000 franchises right now. And each franchise generates about $1.1 million in revenue. These are publicly available numbers, you can look it up. So 3,000 times 1.1 million, that's over $3 billion in revenue. And Jersey Mike's royalty fee is 6.5%. So 6.5% of over $3 billion is a little over $200 million. So that's how much is the overall net revenue that the franchisor is getting from all the franchisees. And their operating expenses are pretty low because they're actually charging the franchisees for training and things like that as well. So we could reasonably assume that their net income is about $200 million. So if it's $200 million of net income, and they paid $8 billion for it, that's 40x multiple that Blackstone Group paid to Jersey Mike's, to Peter Cancro. Now let's look at how Blackstone could have structured this deal and what their return on investment would be on such an investment. So this is looking at the current state, year zero, revenue per store of $1.1 million, 3,000 stores, about $0.2 billion or $200 million in net income that's going to franchisor Jersey Mike's. And they paid a total valuation of $8 billion, right? How would they have structured this? And we also know one more thing, that is Peter Cancro actually rolled over significant amount of his equity into Blackstone. So let's assume that he rolled over 20%. So his equity share here is $2 billion that is rolled over into this $8 billion. And we can reasonably assume that he probably is carrying a seller note of another $1 billion. So that's $1 billion. And Blackstone probably put an equity investment of $1 billion into this thing. And they probably got debt financing for $4 billion. So that's how you get to the number of $8 billion. 4 plus 2 plus 1 plus 1. Now, if we take a step back here, the reason why a company like Blackstone would make an acquisition like this is if the franchisor is looking to grow. If they have a significant competitive advantage, let's say Jersey Mike's they discovered a way where they can source great ingredients at great prices, and they can create a great experience for their customer, and they can ensure that there's high sales for each franchise location, and the franchisees are actually making significant income, so there's high demand for franchise locations. So if Jersey Mike's can ensure that, but they're looking to grow really fast before competition can catch up with them, that's when they'd be looking for external investment like this, because they want to grow faster than they could grow by themselves, or they want to grow faster than they could grow by getting something like mezzanine debt and doing this entire franchise expansion model themselves. So that's why they'd be looking for an acquisition from an external party like Blackstone. And you can see this in Steve Schwartzman's video as well. He's talking about how they're looking to help Peter Cancro grow the franchise. So let's throw out some numbers here and make some assumptions. So today they have 3,000 stores. Let's say in the next 5 years, they expand to 10,000 stores. Is that too aggressive? I don't think so, because if Jersey Mike's has a great product market fit with the financial backing of a PE company like Blackstone, they could get to 10,000 stores because they're doing international expansion. They're not just looking to expand within the US. They're going to other countries. And let's also assume that the revenue per store, which is 1.11 million today, let's say they can increase that to $1.4 million in the next 5 years, which is very reasonable because just the price inflation will get them there. So at this number, $1.4 million per store, 10,000 stores, and so the royalty fee is 6.5%. Let's say it goes up to 7% in the next 5 years, right? So that right there is about $1 billion EBITDA. So they go from 0.2 billion to $1 billion EBITDA. So now that's $1 billion EBITDA, about $14 billion total revenue. Let's say at this point they decide to go for IPO. 1 billion EBITDA is a great number to go to do an IPO at. And if we think about how much post-IPO valuation they may be able to get to with $1 billion EBITDA, it could be pretty high. It could be 30x or 40x even. There were companies like Snowflake, DoorDash that got to $60-80 billion market cap when they were actually not making any money. So let's conservatively assume that they can get to a market valuation post-IPO of $25 billion, right? That's pretty conservative. So now let's figure out how much money each of these players get. So Blackstone would have also made some investment into this after making this initial acquisition. And let's assume that they were only paying interest on all this debt and all this seller carry portion until now, and they just need to pay out the entire principal at this point. So of the $25 billion, let's see who gets what. We have to start by paying off debt because assets equal liabilities plus equity, right? Liabilities take preference over equity. So let's start by paying off debt. And the most senior debt is the bank debt. So that's $4 billion that they'll need to pay off here. That's 4. And then the seller carry note is right behind that. So that's another $1 billion. $5 billion gone. So of the $20 billion left over, now Peter Cancro and Blackstone split that. Peter Cancro gets quarter of that, right? So that's 25% of 20 billion. That'll be $5 billion. And the leftover $15 billion goes to Blackstone. So Blackstone has put in $1 billion as initial equity investment, and they're getting $15 billion. That's 15x return on investment. Even if Blackstone did put in other investments here to grow the company after their initial acquisition, they will conservatively make over 10x return on investment on their initial equity dollars. And Peter Cancro made $5 billion initially, right? And he rolled over $2 billion and $1 billion was seller carry. So he made $5 billion initially, and then he made another 6 here. So he made overall $11 billion, and Blackstone netted $15 billion in this scenario. So that's how much this acquisition could mean for Blackstone and for Peter Cancro. That's a lot of money and hopefully a lot of good sandwiches.